Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're talking about how to invest in AI, or artificial intelligence. AI has been in the news quite a bit recently. You may be familiar with OpenAI's ChatGPT, which is available for free to anybody who signs up and is something I've tinkered around with a little bit. It's a rapidly evolving field. It's a rapidly evolving technology. Some people have concerns about the level of authority we should give artificial intelligence. But I think the chances are very, very high that regardless of what direction this takes, it's going to have a substantial impact on the way that we do things as a race and just in general in industry and our work and our personal lives and really just across the board when you think about day-to-day life over the next 10, maybe 20 years. So I thought it was worth a podcast episode today to talk about how we might think about including this theme and this quote-unquote opportunity into our portfolio. Because oftentimes we think about how new technologies are going to impact our portfolio, our lives. We want to put those things in our portfolio and jump on this opportunity. So I just wanted to put this in perspective based on our investment philosophy here at the firm. I hope it's helpful. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. This week on the show, we're going to talk a little bit about how to invest in AI. And the reason that we're doing that is you see this a lot in the headlines of what AI is doing. You hear about ChatGPT and how this particular technology could be a turning point for all technology and maybe even the human race more broadly than that. If you think back to other technological innovations, like you have the printing press, you have computer chips, you have the internet, all those were had very substantial impacts on humanity and in the investment markets. And AI seems to have the possibility of being one of those turning points for us now. So there's a lot to this, and I wanted to cover today how we think of this with respect to investing in general. Does the potential of this technology mean that we should devote portfolio allocations to individual companies or try to invest in this trend? How does all this stuff fit together? Because you see it in the news all the time. It has a massive potential. There are also a lot of people who are worried about it in like a Terminator kind of situation. If the AI takes over, what happens then? And this is something that's raising, I think, a lot of questions and is really piquing people's interests. So maybe it would make sense today to start with just a general overview of what I mean by artificial intelligence and where we're at right now. And for those of you who've not heard of OpenAI or ChatGPT, OpenAI is a company. It started out as a not-for-profit open source company that was, I think, funded actually primarily by Elon Musk to create some form of artificial intelligence that is available to everyone and is open source. What open source means is that the code and all the guts of it are available to anyone all the time for personal use. And that part of it is particularly important because it helps prevent censorship and other issues that you might get with such a technology. So OpenAI is this organization that started working on it. At some point along the road, they became a for-profit company and decided to go in a different direction and close their source code from users. So what is it that I'm talking about? What are they building? It's basically, they call it a chatbot. That's why it's called ChatGPT. You log in, you can create a username and profile for free. You ask questions to this chatbot, and what the program does is scours what's available on the internet. Currently, I believe it only goes up to 2021. No data more recently than that has been fed to these learning algorithms, these machine learning algorithms. And the AI or that chatbot interprets your question, interprets all the available information that's been fed to it, and then comes up with a cogent answer. And most of the time, and I've tinkered with this a little bit, most of the time the answers are somewhat cogent. Sometimes they're not. They're flat incorrect or way off on a tangent. The thing about this is that it's pretty good right now. It used to be very rudimentary, but it's getting better really rapidly. There's no like sentient being, being created by that. I don't believe, and I'm not, to be clear, I'm not an expert in this, but I do try to stay informed. And the concern I think a lot of people have of this thing becoming sentient and, starting to lie to us and taking over is a really reasonable fear to have. But I don't think that's based on my understanding today. I don't think that's possible in its current form with how it's set up. Okay, so that's where we're at, and the implications of this are huge long term. It can replace a lot of stuff that's out there. Think of going to like the gym. You work with a personal trainer. Part of the benefit of a personal trainer is having them come up with fresh, workout plans for you. This ChatGPT can do that for you. And, if you have like a strained calf muscle or something like that, you can have it suggest exercises for you to do if your objective is to lose a couple pounds a month or to put on muscle mass or something like that. Now, it's not going to be in the room with you pushing you to complete all these exercises, of course, but it is beneficial, nonetheless, if you're a self-motivated person. Now, a lot of financial advisors like myself have been wondering whether this could supplant us in our roles in working with clients. And I think for some of the questions people might have on their own, AI will definitely replace a professional. If you have questions about, hey, here's my adjusted gross income, what can I do to pay less in tax and reduce it? It'll scour the internet and come up with some solutions. You might eventually even be able to feed in all the data from your own tax return in your own situation, and then ask it questions to come up with solutions. That's a very reasonable and probable thing that will happen. But it doesn't have, you don't have a relationship with it. It doesn't have human empathy. It doesn't, and it's wrong a lot of the time currently. And the reason for that is because these machine learning models learn and come up with their responses based on what information is fed to them. Okay? So one of the issues with this, back to the OpenAI situation, is that if it's open source, you can potentially use the program and feed it everything or what you want to hear or what you don't want to hear, or a combination of both. But if you're a closed source or for-profit organization, and OpenAI is one of these companies, but rest assured that Google and Microsoft and probably a few others are trying to create their own AI interfaces for similar purposes as OpenAI is. And those for-profit companies will definitely not open their source code to everyone. So there's the potential for censorship here. If the political persuasion of the management of one company leans right and the other company's leans left, it's very possible that they might decide to feed their machine learning algorithm, their AI bot, a limited subset of what's out there on the internet. And so the response that you might get to questions that you have, or anybody using it has, could lean in a certain political direction at the discretion of whoever controls that program. So that's in a nutshell what's going on, or at least my understanding of it, which is I'm sure incomplete, but I think generally correct. Now, the long-term implications of this are potentially very, very large and very helpful. And people way smarter than me think that this could be a turning point like the internet, where 10, 20 years from now, this is just going to be everywhere and a part of our everyday lifestyle. So the question that's coming up is, well, okay, that sounds great. I believe in it. How do we invest in it? Sounds great. And an example of why, or a reason that I think a lot of people are becoming interested in it is NVIDIA. NVIDIA is a chip maker. They have been up in a huge way year to date because they have hardware. I believe it's chips, but it may be other hardware related to that. I'm not 100% sure. That is especially conducive to AI technology. And so their stock performance has been astronomical this year. And it's that kind of exposure, or that kind of experience, and that kind of stock chart, if you will, that's generated a lot of interest in this kind of stuff. So there's a couple ways to play this. Number one, I'll start with just micro level. If you want to devote cash or portfolio assets to AI, here's some companies that are involved in it. You can buy some funds. One of them is XT, which is an iShares fund for exponential technologies. But I want to get into the pros and cons of this, as well as the broader term implications for your portfolio if you go that route. So the companies that come to mind that will be directly involved in the development of AI and will benefit as AI starts to gain traction in society. Think of definitely Google, Amazon, Microsoft. Baidu is one that will benefit. IBM, NVIDIA that I mentioned, Oracle, Palantir, Tesla, Adobe apparently is making a large investment in this kind of technology. So if you're someone who wants to put portfolio dollars toward a specific company, that's the route that you would go. If you want to devote portfolio dollars toward a fund that invests in a whole bunch of companies and where you don't have that single security risk, then you probably want to go toward XT or another, and there are a bunch. I think it's AIQ or maybe AIE or AIEQ, something like that. There are maybe a dozen of these things available on the market where you can put portfolio dollars toward ETFs or mutual funds that have exposure to tech companies in this specific subset. Over the long term, I think that's probably better. You're going to be better off doing that than if you're investing in individual companies. For example, XT, if you spread it out across 197 companies, if one of those 11 or 12 that I just rattled off does phenomenal and goes up by 300% in the next 3, 4, 5 years, you'll have exposure to that. But you don't have to pick which one of those 10 or 11 or 12 it's going to be. You have a little bit of exposure to everything. And there's just evidence, there's time period after time period after time period where investors have better long-term returns, better long-term investing experiences by investing broadly in a diversified way. Don't try to pick the 1 or 2 or 3 that's going to do the best. Just buy them all in that subset, okay? Now, I am setting this up a little bit because I don't think that's going to get you to the best outcome either. And the reason is that over and over and over again, growth investing is short-term return and not quite as good longer term when you stretch out the time periods. And so what do I mean by that? Well, for example, growth investing between 2010 and 2022 did way better than value. And what I'm talking about here is all the companies that I rattled off, with the exception of a couple, are very heavy on the growth side of the spectrum. They have innovative stuff they're doing. They're growing revenues. They're gaining market share. The markets they're in are expanding. This is an example of that, where AI kind of technology will probably grow and take off. And if you have a foothold in that market and a reasonable market share, you don't have to grow market share. The size of the pool is just growing so quickly on its own that it will drive a whole lot of revenue. And to keep that foothold, they'll reinvest profits back into the company really aggressively. Value companies are not as innovative. They're not nearly as expensive relative to the earnings that they produce, but they'll often kick some cash off to investors in the form of a dividend, and they'll be a lot more, like I say, reasonably priced relative to the earnings that they produce. Now, of those companies I rattled off, if you look at the income statements and their activities and their actions and so forth, and what their dividend yields are, all but two, the two exceptions being IBM and Microsoft, are heavy on the growth side of the spectrum. And so a better way to invest is just to invest broadly in everything. And rather than having an equal portion of your portfolio in each of those individual stocks, so if the stocks in your portfolio are going to be in the S&P 500 only, even if you purchase an index fund, you have exposure to those 500 companies. But how much exposure to each of the 500 companies do you have? Most index funds, well, all index funds that are cap weighted, skew toward growth and away from value because of the way that they build those lists of the S&P 500. I've talked about this on the podcast in the past. Apologies if it's redundant, but market cap means the number of shares that exist multiplied by the price at which they trade. Your growth companies that are more expensive relative to the earnings that they produce are naturally going to have a larger market cap. And therefore, if you buy the cap-weighted index fund, it's going to skew toward growth. Now, I say this because there's been a lot of research done into what stocks outperform over the long run. If we have all these stocks that we can invest in, both in the US and abroad, what are some characteristics of those that tend to outperform? And value tends to do better than growth over and over and over again. If you go back to 1926, and for today's episode, I was brushing up on some stats. If you go back all the way back to 1926, over 1 year periods, value does better than growth about 60% of the time, 60. Over 5 year periods, it does better 70% of the time. And over 10-year intervals, so meaning 1926 to 1935 through 1935, 27 through 36, you go forward, right? In 79% of those intervals, value does better than growth. And that doesn't comment on magnitude, but it's consistent and it happens over and over and over again. And the reason why is that competition always wins. And this is really the point that I wanted to get to in today's podcast, is if you're going to invest in AI technology, you can try to pick public or private investments that are going to benefit from this technology in that market growing and changing industry and changing, life as we know it. But you have to pick the right one, and that's just exceptionally, exceptionally hard. For example, if we were having this conversation a year ago and you decided to invest in NVIDIA, that would have been a really good decision because the 1 year returns for NVIDIA have just been astronomical, like I said. But let's stretch that out over a longer period of time. NVIDIA has some hardware and some chip and some stuff that they're doing that's really conducive to AI. But all the other public and private companies, right, industry wants a piece of that action. And some of the stuff that NVIDIA is doing, they have intellectual property over, but competition is going to start chipping away at their competitive advantage. Other companies are going to figure out what they're doing and figure out how to produce a similar solution, a similar product, similar service, whatever it is, and maybe they're able to do that in a way that circumvents the intellectual property. Maybe they're not, right? But at this point, NVIDIA has the lead, and everybody else now is trying to figure out how to catch up, because they know that NVIDIA's product has led to a lot of market performance, and because of the potential for AI down the road, they want a piece of that, right? And this is true over and over and over again. It's the nature of our economic system. It's not specific just to AI or just to microchips or internet or any specific industry or product or service. So if you're buying NVIDIA now, you're betting that company's competitive advantage today is not going to go away anytime before you decide to sell the stock. And I can tell you, it is exceptionally hard and really impossible to figure out when the right time to sell that stock is. You never know, because we don't have all the information that you need to make that decision in a productive way for your accounts and for your returns. So all these other companies are going to be chipping away at their competitive advantage. And what tends to happen is you have a company that comes up with a new product or service. They grow market share. They are maybe they have a foothold in a growing market, like in this circumstance. And then all those other companies, and the ones on the growth side, yes. So your Googles, your Amazons, your Palantirs, your Oracles, they're all going to try to figure out how to do similar stuff. But it's the value companies on the other end of the spectrum that weren't first to market. They weren't doing anything terribly innovative. They're just finding ways to get a foothold in a market of growing size, are the ones that provide most of the competitive pressure. And that's the primary reason that value has done better than growth over multiple intervals for a long period of time. And you can always cherry pick. And I picked out the 2010 to 2012, or excuse me, 2010 to 2022. Growth did way better than value. There are always going to be some periods mixed in there where growth outperforms. This isn't going to happen every single time, but there's been enough history behind this and enough data supporting this as an explanation to how our corporate competitive atmosphere really plays out in the marketplace, that this is really the superior way to invest, is bet on competition eating away at market share and getting into that market somehow down the road, as opposed to trying to pick the winner before it happens that's going to have competitive advantage and keep it over a long-term period of time. Because in investing, and even if you go the fund route, the one, XT represents 197 AI exponential technology, AI adjacent companies, and their definition of how they're deciding what companies go into that portfolio is a little bit different than AI adjacent. But it's along the same lines. Those are almost all, well, I shouldn't say all. When you purchase that fund, the vast majority of your holdings in that fund are going to be on the growth end of the spectrum. And that's the side of the spectrum that is, the first through the door with a target on your back. I'd rather be the second. I can't remember how the quote goes, but I'd rather be the second person through the door because the first person is laying face down in front of me with arrows on their back. I'm bastardizing the quote, but you may have heard it before. So investing broadly and tilting toward value and away from growth is the superior approach here. And it doesn't matter what period in the market we're in. It doesn't matter, that this idea of artificial intelligence and its promise and future implications might mean that we want to, try to pick what company is going to benefit from that and invest in that company. I think you're actually better off reaching a better and more consistent positive outcome for you by investing in everything. I'm not saying abandon growth. I'm just saying lean a little bit more toward value and away from the growth side of the spectrum. Because that, if you just look at the frequency, and we're looking at 100 years of data here, it just tends to do a little bit better. And you're more likely to reach a better outcome by taking that route, as opposed to, okay, is it going to be Amazon? Is it going to be Microsoft? Is it going to be Google? That's a huge guessing game, and you're more likely to be wrong than right. Okay, I hope this was interesting. It's something that, again, it's been in the news a lot. And by the way, before AI, it was the FANG stocks: Facebook, Amazon, Apple, Netflix, and Google. Those five were driving a lot of the S&P 500 returns before this AI craze. And that period of reading about the FANG stocks and their contribution to aggregate performance, it's kind of in the rearview mirror now. But that was really up through the end of last year that happened. So it's a trend thing. There will be other technological improvements people will get excited about, but through and through, the more consistent path to the best outcome is just leaning a little bit in the other direction toward value. Because I'd much rather bet on competitive market forces in our capitalistic system than I would betting on which organization is going to achieve and maintain competitive advantage over the long run. All right, that's it for today. Hope this was helpful. Talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.